Hello everyone, this is Thomas Newman from the CIMA Hub. Today I want to look at the November 2016 management case study with a particular emphasis on the financial statements of Portafone, which is the subject for this particular exam. Before we start, I would like to mention that the CIMA Hub is a brand new website with a focus on providing high quality materials for CIMA students, and the whole aim is to make life easier for the CIMA student, to provide expert materials that give you a serious edge during your objective tests and your case study exams. So please do go along and check out the website. You have the address there, www.thecimahub.com. Make sure to subscribe as well. Our subscribers receive some really excellent free materials. For this particular case study, there's a really useful financial analysis and ratios file that you receive upon subscribing, so I highly recommend that. Okay. The management case study for November 2016 puts a real emphasis on the financial statements. Around 1/3 of the entire pre-scene is made up of financial statements for both Portafone and its rival Maltone. So you really need to know those figures quite well. You need to be very familiar with the main issues as they relate to the financial statements. What you don't want to be doing on exam day is jumping back and forth between your unseen requirements and the pre-seen materials. You're going to waste a lot of time if you do that. Okay, so we're here to help. Let's take a look at the profit and loss statement first. Okay, this is for Portafone, and the things that jump out are the strong revenue growth. Okay, for 2015. But it's matched by cost of sales, so the effect is the strong revenue growth is somewhat nullified by that equal growth in cost of sales. On the other hand, the operating costs are being held down. In particular, it's interesting to note that research and development expenses are almost flat for the year, and I would question the wisdom of that approach for Portafone. We'll talk a little bit more about that in a minute. And there are good profit margins for the company in 2015. These two are related, obviously. The fact that the operating costs are being held down is impacting on the operating profit margin and net profit margin and the positive effects we see there for 2015. Okay, looking at the top two lines of the profit and loss statement, what we see when we look at revenues is that we have growth of almost 14%, but cost of sales matches that growth, okay, almost the exact same. So what it tells us is that the cost of sales are rising in step with the revenues. So let's say Portafone has shipped more volumes of their mobile phones in 2015, while the cost of sales is rising at the exact same rate. So it's still impressive, that revenue growth, given the fact that the smartphone market between Q2 2015 and Q2 of 2016 grew just 0.7% as a whole. Okay, so Portafone is way ahead of the average for the industry, let's say. While cost of sales is rising quite a bit in 2015, that's not the case for the operating expenditures, research and development costs, and selling and administrative expenses. Research and development is up just 1.2%. That is significant because this is a high-tech industry, an industry in which innovation is key. Okay. It's a kind of a perfectly competitive market in that you've a number of players all jostling for position. The customer is quite well informed. They have power to switch brands quite easily, and the prices, let's say, are not so much dictated by one or two dominant players. They're more, it's more the consumer and consumer demand that drives the prices in this kind of market. So what we see is that technical innovations are very important in the market. Just to keep up with competitors, technical innovations are key. They're quickly mimicked by competitors, and as a result, well, the consumer has access to some excellent products, but it is necessary to spend a lot on R&D just to keep up. And Portafone has not really done that in the last year, and I would question the wisdom of that approach. Okay, it has had an impact on the operating profit margin, which has increased very nicely. Okay, the operating profit margin is up 58%. Sorry, the operating profit is up 58% between 2014 and 15, and that is a healthy operating profit margin of 12.8% that we see in the P&L. And the net profit margin is also quite healthy at 10.4%. Again, it's up on 2014. What about the balance sheet? These are the key points to note for Portafone. It's a little bit surprising that intangible assets are so low. In an industry where you have technical innovation as a let's say a critical success factor, you might expect intellectual property to play a big part in the industry. And it's a little surprising to note that Portafone has not got so high a value on its intangible assets. We'll look at that shortly. Portafone is, however, a highly liquid company, and in particular their cash position is very, very strong and has grown greatly between 2014 and 2015. It's interesting to note that retained earnings has no separate line in the balance sheet. There are two possible reasons for that we'll look at now. And finally, debt is slightly up in 2015, but I have to say that it's not really a huge issue for the company. The gearing is still quite low. Okay, intangible assets. Intangible assets for Portafone represent just 7% of the value of non-current assets. You would expect maybe to see that amount being much higher when you consider, for example, that Apple had $8.7 billion in goodwill and intangibles in 2014. You might expect Portafone to have a higher percentage of their total non-current assets represented by intangibles, okay? Intellectual property, patents, trade secrets, etc. But it's not the case. And what that indicates to me is that Portafone is perhaps not a market leader, okay? They're not at the cutting edge of innovation. They are very liquid, okay? And you can see the cash position rose 41% between 2014 and 15. They have over 10 billion dollars in cash, okay? And they're also a highly liquid company. When you look at the current ratio, which is your current assets over current liabilities, you'll see that it's 3.9 in 2015. Okay, so very, very liquid company. Even when you strip out the inventories and you look at the quick ratio, you've got a ratio of 2.9 in 2015, and they're improving positions over 2014. So no worries with liquidity. I would say inventories, it's key to focus on inventories in this industry. Okay, Tim Cook famously, he's the Apple CEO, he famously said that inventory is evil in this industry, where you've got items like iPads, tablets, and smartphones, where technical evolution is a constant. okay? And you have competitors constantly evolving their offers, copying each other. You don't want to be stuck with a high inventory, okay? Because those items can become obsolete very quickly indeed. And Apple has obtained such a winning position to a large extent based on their absolutely world-class supply chain management for one, but also their inventory management, okay? I would also say that while Portafone has no real concern about liquidity, and in particular that liquidity is bolstered by the huge cash stock that they have, I would wonder if that cash could not be put to a better use. It's sitting presumably in a bank account somewhere, generating not very much in the way of interest. Could they not find a better investment that would generate a better return for the company? We come to the ambiguity created in the pre-scene by the fact that there is no line for retained earnings as there usually is. And what this means, it could be one of two things. I think the most probable explanation is that retained earnings is simply included in the equity attributable to owners. That's the most likely scenario. But there is a second scenario which we should entertain. We should keep it in mind. You don't want to be caught out on exam day if this comes up. Maybe Portafone is paying out very generous dividends indeed to its shareholders. Okay, maybe they're not retaining any of their earnings and are simply paying out those dividends. Well, if that's the case, and I don't think it's too likely, but it could be, if that's the case, they need to consider the tension between keeping shareholders happy, and undoubtedly they would be if they're getting all of those retained earnings, and reinvesting in the company and seeking out investments that will make them more competitive in the future. Also, another point to note is that if they have paid out dividends and used up all their profit in doing so, it would also indicate that they've issued shares in 2015. You'll see that equity attributable to owners has increased between 2014 and 15. So that would be a consideration as well. You'd wonder why, given their large cash position and the fact that they've taken on more debt, we'll see that in a minute, why would they issue more shares? Presumably they're building up some kind of financial war chest for something. We don't know what, but something to keep in mind. And then looking at debt. This is not a highly indebted firm. Gearing stands at just 12.6% in 2015. It is up by 52% though on 2014. So gearing is still low, but we need to ask ourselves, why would Portafone take on debt considering the fact that they have such a strong cash position? As I said before, they seem to be building up their finances, readying themselves for something. We don't know what. Maybe it's an acquisition. Maybe it's some kind of capital expenditure project that they've got lined up. Who knows? Finally, we come to the rival, Maltone. It's telling that CIMA has chosen to include the financial statements of Portafone's rival Maltone in this pre-scene. Okay, it's an interesting comparison because what we see is that Maltone is a very similar sized company to Portafone. Certainly their revenues, their profits, etc. are of a very similar size, but what's interesting is the trends over the 2 years between 2014 and 15. And what we see is that whereas Portafone had strong growth in revenues, Maltone has flat revenues. Whereas, well, actually, where they where we witnessed the same trend is in cost of sales, because Portafone also had increasing cost of sales, as does Maltone. And the net profit for Maltone is down, whereas for Portafone it's up. Okay, so Portafone, it seems, is perhaps stealing some market share from its rival Maltone. And it's also interesting to note that Portafone has a heavier balance sheet than its rival Maltone. Maltone, I wonder, are they outsourcing production, and is this leading to the lower figure we see for non-current assets in particular? What Maltone is also doing is lowering their debt position, okay? Whereas Portafone is increasing its debt, Maltone is reducing its debt, and is probably right to do so given the fact that its gearing was quite high in 2014. We'll see the specifics of that in just 1 minute. And the final point about Maltone is that they're actually quite good at putting their assets to work, better than their rival Portafone. Okay, we'll see the details of that now. But starting with the P&L, the profit and loss for Maltone, and as I said, their revenues are of a similar level to Portafone, as are their cost of sales. But the trends are what is really interesting. Maltone has suffered a slight decline in its revenues, whereas Portafone had very healthy growth of 14%. Cost of sales then, well, that's a big issue for Maltone. They've got an increase of 11%, which is lower than Portafone, but as we said before, Portafone's cost of sales are rising in step with its revenues. It's just probably that its variable costs have risen as volumes have gone up. But Maltone has got a problem there because its cost of sales are a little maybe out of control. And then we see the net profit for the year down 30.7% for Maltone, whereas Portafone has witnessed almost 59% increase in its net profit for the year. Very good. Maltone does, however, have a better net profit margin, 10.9% versus Portafone's 10.4% in 2015. But as I said before, what's really interesting is the trend, because in 2014, Maltone had a much stronger position than its rival Portafone. What we saw then was that in 2014, Maltone's net profit was 16%, the margin was 16%, whereas Portafone's was just 7%. So it's quite a turnaround, and Portafone is catching up to its rival. The balance sheet, as I said before, it's got a much lighter balance sheet than Portafone. Okay, and you can see there the non-current assets compared between Maltone and Portafone. $957 million is the value of non-current assets for Maltone against just over $4 billion for Portafone. So that would lead me to a question, and I would say it's probable that Maltone is probably outsourcing its manufacturing in the same way that Apple does. Apple famously outsources the manufacturing of its mobile phones to Foxconn of China, which is a specialist in low-cost production. And then Apple is free to focus on design and all the other things that make it strong, marketing, etc., and excellent inventory management. A few concluding remarks about Maltone. As I said before, it's telling that CIMA has chosen to include the financial statements of Maltone in this pre-scene. And I wonder whether we're likely to see in some of the variants some problems relating to a possible acquisition of Maltone or a merger or something like that. Maltone is on a downward trend, on a downward slope in terms of its revenues, and maybe its shareholders would welcome an approach from Portafone. Portafone, as we said, has built up a strong war chest of finances. It's in a position perhaps to acquire in order to grow. And Maltone is quite an attractive proposition for Portafone because it's better than Portafone at putting its assets to work. And we can see with these three ratios, the return on capital employed, the return on assets, and the asset turnover, Maltone is quite a bit ahead of Portafone for these three ratios. These three ratios essentially show us how Maltone is putting its assets to work. Okay, how they're generating more in the way of net profits and revenues, at least compared to their asset base, and it's interesting to see the differences there. Okay, that's it. I hope that this video has been of use to you. If you feel like more, head along to the CIMAHub.com, where you've got 3 specific articles related to this particular November 2016 management case study. And as I said, do subscribe. You're going to get a free financial calculations and ratios PDF if you do. It's very, very useful for this case. And you'll also be notified of the excellent articles and different features that are coming up in the future from the CIMA Hub. So do go along to the site and do subscribe. Many thanks and good luck.